Good morning and welcome to this Monday, July 11th, 2022 edition of Trading Places live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, we start off another week and looks like we're probably going to see at least maybe a little bit of weakness to open the session. We had futures down pretty much overnight. And just looking right now, I mean, this is probably from about 10 minutes ago, but Dow Jones futures down 190 points. S&P 500 futures down 28, NASDAQ futures down about 95. Keep in mind, it's Monday. And you might think, well, what the heck does that have to do with it? Well, historically, this is your worst day of the calendar week, and it's not even close. Since 1950, the S&P 500 has an annualized return of minus 15, maybe it's minus 14% on Mondays. That's going back 72 years. That's a lot of Mondays. I mean, if you think about it, where you said it's just one day of the week. Well, yeah, it's just one day of the week, but it's one day of every week for the last 72 years. That's a lot of time. So I never, I don't even blink when I get up on Monday morning and I see the futures are down. Usually the market does have a tendency to struggle on Mondays. And I know that based on fact, based on long-term analysis. So I wouldn't read too much into that, although we did come up and hit some key price resistance last week. And we're going to talk about that a little bit. But yeah, I mean, we're going to get off to what looks like probably is a little bit of a weak start today, and then we'll see where we go from there. But we've had a really nice rally over the last month or so. We've saw the market bounce. It pulled back, but it put in a higher low, and now it's trying to bounce back, get through the 50-day moving average, trying to get through some recent price highs. It's got some gap resistance to deal with. So we've got some issues. And short term, kind of what I was talking to members about last week in my daily market report on Friday, we got to get through these levels, and it may not be easy. We may not do it on this attempt. I don't know. But I do think overall the signs in the market still remain mostly positive. A couple things worry me a little bit, and I'll talk about that in just a minute. But before we get into any of that, let me take those of you who are new. I'll take all of you over to EarningsBeats.com. But those of you who are new, if you go over to EarningsBeats.com and you scroll down, we do have a free newsletter that's published Mondays, Wednesdays, and Fridays of each week. All it takes is your name and email address. No credit card required. You can unsubscribe at any time. It's really an opportunity for us to give back a little bit and just take a look at the market and help everyone, at least give you our opinion and the way we approach the market, give everyone a little bit of a taste of how we look at the market, that sort of thing, which is mostly earnings related, relative strength related, candlesticks, volume analysis, many of the standard technical analysis, pattern recognition, and so forth. Those are the types of things, that we're generally going to be looking at and pointing out in that newsletter. But again, 3 times a week. It's a very quick read, by the way, just, a couple paragraphs in a chart. Also, I wanted to mention that tonight at 4:30, we will be having a webinar to talk about our model ETF portfolio. This is a sneak preview. We have been a little bit conservative in our portfolios, especially this model ETF portfolio since back in January, and it served us well. We've outperformed the S&P 500 in each of the last 2 quarters during this downtrend in the market. So while they haven't resulted in positive gains, it has been better than the S&P 500. And I think that's a lot of what you want to do. You want to try to preserve as much capital as you can when the market is weak, and then be prepared when the market is strong to move into more aggressive areas to outperform. And so we'll talk a little bit more about that tonight. But this is a free event. Next week, when we actually announce our portfolios, our model ETF portfolio, that'll be members only. But if you just want to come in and learn a little bit more about how we put these portfolios together and what we look for and that sort of thing, where I think the market stands right now, tonight will be a great session to attend. And again, that is a free event. Anybody who is an EarningsBeats Digest subscriber, our free newsletter I just talked about, we'll send you room instructions. So one more reason to be on that EB Digest newsletter list is that when we do these free events, we invite you. We invite all of those in our community to our events. So again, you want to check that out. Make sure that you are an EarningsBeats Digest subscriber. Again, all you have to do is scroll down, put in your name, email address, hit that subscribe button, and we'll get the instructions out to you. And you can join us at 4:30 this afternoon for what I think will be a very educational event. All right, let's take a look at the market action from last Friday. Dow Jones Industrial Average down 46 points, S&P 500 down 3. NASDAQ was up 14, so a little bit of a bifurcated market on Friday. NASDAQ up, the other two down. Mid caps down 7.6 points and small caps down almost 3 points. So you can see they went down as well. So NASDAQ was the only major index to move higher on Friday. One thing I want to point out on this chart, though, look at all of the AD lines on every one of these indices. The only one that is not at or setting a new 52-week high, or at least a new actually, I think this is probably an all-time high. But the only one is the NASDAQ, and it's not far from breaking out above that late March, early April high. And I just say this because as the market keeps going down and putting in lower lows, lower highs, the AD line is doing the opposite. And if you understand how the AD line works, if you're finishing in the top half of your candlestick for that day, in other words, your trading range for that day, if you're in the top half of it, the AD line goes up, even if you went down for the day. So to me, it's almost like one of these ways or one of these things we can use to see if the market's being manipulated to the downside. Now, I wouldn't say this is a guarantee that, hey, the market's going to come back. The AD line, I've seen it go up plenty of times with stocks going down. The stocks keep going down. The AD line ends up turning back down. But it is one signal that's worth at least noting that, hey, prices are going down. Normally, when prices are going down, you would think that you're going to probably finish in the lower half of your trading range more often than not, sending the AD line down. And on those really bad days, the volume's a multiplier. So you've got, when you have a really bad day, if you have heavy volume, then that's going to really impact the AD line to the downside. If you have if you're closing in the lower half of the candlestick, especially if you're closing at the bottom of the candlestick, that'd be 100% of the volumes being subtracted. So it's just worthwhile pointing out, I think, prices have been going down, AD lines have been going up, which could be a signal of Wall Street accumulating while we've been going through this cyclical bear market. And it really kind of goes right along with what I've been saying, what I was saying before we even went into this downtrend, which was that I was expecting some pretty significant down action in 2022, potentially calling for a cyclical bear market back before the market even started to decline. But at the time, I said I thought it would be a cyclical bear market, that we were ripe for a sell-off. And I was using, back at that time, 3 to 6 months. And then middle of June, I called a bottom. That was 5.5 months later. So we'll see whether or not this all plays out. But the AD line, I think, is really important because it is at least telling us that there's a real possibility that Wall Street's been accumulating while everyone else has been panicking and selling. As far as the sectors go, you can see healthcare was the best performing sector on Friday. Technology and discretionary also up fractionally. These were your only 3 sectors that moved higher on Friday. Like I said, most of the indices were down. The NASDAQ was up just slightly. And it's because there were only 3 sectors that were higher. The other 8 were down. Materials, the worst one, down almost 1%. Communication services down almost 0.5%. You can see, by the way, on some of these charts, how important these moving averages are, or could be on many of these indexes. Communication services turned down just as it was getting to the 50-day. Look at where we are on discretionary, 50-day. Technology, right up to the 50-day. Healthcare actually has moved through the 50, getting fairly close to what I would consider a key area of resistance, probably around 133, 134. So if we can negotiate that level, I think that would really bode well for healthcare. We could make a run up into the 140s at that point. And if you look at the AD lines, Healthcare, even though we're down $10 from where we were a few months ago, AD line, new high. Technology's been downtrending, but notice the AD line uptrending. Same goes with discretionary, downtrending, but start with this March low right here. May low on the AD line was higher. June low was higher, even though price action keeps going lower. Materials even. I mean, look at materials in a free fall the last month, and yet the AD line sets a new high. Communication services still a little bit weak, but this is a key area right in here, resistance on the AD line. I'd like to see that get through. But overall, I'd say the action, even though it's been down, I really think the last 30 days has shown some real positives, and we just need to confirm it. We need to get through some of these levels. I think the 50-day moving average is one thing. Getting through key centerline resistance on the PPO is going to be another. Healthcare is doing it right now. Technology, discretionary, communication services, these are three aggressive areas. They still got work to do. None of them above their 50, none of them above the center line on the PPO. So this isn't just at this point, just go all in and you know, in the short term, especially. I mean, I did talk about being all in a month ago. And I'm pretty heavily invested. My retirement accounts are still completely invested. I'm not planning on trading those at this point. I'm just holding because I believe the bottom's in. My trading account, as I mentioned at the end of the last week, I've gotten out of leverage. I don't want to be levered at all at this point because we don't know if we're going through these moving averages. I think coming off that recent low in mid-June was a perfect time to be leveraged if, you know, you're willing to take the risk. Not everybody is, and that's fine. But if you're willing to take the risk when you get sentiment readings where they were, and you start seeing signs of rotation into aggressive areas as you're setting new lows, those are signs that Wall Street, I mean, why would, on a new low, just ask yourself, why would Wall Street want to position themselves in more aggressive areas if we're just breaking down and moving down to new lows? It makes no sense. And if you look back to December, the exact opposite was happening. We were seeing the market moving up to new highs at the beginning of January, and yet money was rotating out of technology, out of discretionary, out of communication services, and into real estate and healthcare and staples and utilities, all the defensive groups. I wrote back then, I think it was on July 4th, or excuse me, January 4th, or might have even been December 31st. But essentially, paraphrasing, my line was, if Wall Street no longer believes in this rally, why should we? That was December 31st. Well, it's flipped. Now, Wall Street's no longer believing in this move to the downside. Why should we? Hey, if you disagree with me, that's fine. Market goes both ways. You know, there's buyers, there's sellers. I might be wrong. But I just tell you what I see in the market. And hopefully those of you who've been watching me for a few years now realize I'm not a perma bull. That was one of the tags, I think, that kind of got stuck on me, that I was a perma bull. Well, when you're in a secular bull market, the market keeps going higher. Call me a perma bull. I'm fine with that. That's a badge of honor. It's a compliment. Market keeps going higher. What, you want me to apologize for being a perma bull? Not going to do it. But if I see issues in the market, I will let you know. 10-year treasury yield. So currently this morning, it is back down a little bit. We're down 7, almost 8 basis points back to 302. Is this a new downtrend that has begun? I don't know. I said, as long as we hold 270, then I think we're in a trading range, 270 up to that 348 high that we saw back in June. We'll see which way we go. If we break below 270, I would say that there's confirmation the bond market is no longer worried at all about inflation. We made a big bottom, big statement with that reversal last week, going back up above 3. Go back down below these lows at 270, and I think you're going to have a downtrending 10-year treasury yield. And that is not what you would see when you're worried about inflation. Bond yields go skyrocketing when bond traders are fearful of inflation. And it makes perfect sense. Again, everything I look at, I try to use common sense. If I can't figure out why something's moving up or down, then I generally don't trade it. I don't rely on it. But the 10-year treasury yield's easy. If inflation, core inflation right now on an annual basis is around 6%, why would you want to own a bond that's paying you 3% over a 10-year period? You're getting a 3% annual yield when inflation's eating away at 6%. And people saying, oh, it's runaway, it's going to keep going. So even more than 6%. Why would you want to own a 3% treasury? You wouldn't. You would sell them as fast as you could, meaning treasury prices would go down and yields would go up. And yet, over the last month, we saw it drop from 348 down to 275 or somewhere in that range before rebounding. Now, I mean, you're going to have periods where, everyone's been selling bonds. So you're going to have periods where they just have these little rallies and yields go back down. But then from there, we should see yields go right back up again and set new highs. And that would be a pretty significant statement, I think, if yields went back up and took out this prior high, because this high right now is looking to me like a false breakout. We moved to an 11-year high. We hadn't seen above 3.25%, in 11 years, or we haven't been above the 3.25 level in 11 years. We did that in the middle part of June. Was that a head fake? Was that move down in the S&P 500 a head fake? Personally, I think it was. So if we go back up and we see the 10-year treasury yield break out and we see the S&P 500 break down, I mean, I'm not just going to pound my fist and say the bottom's in. I know it. I'm going to say, hey, it's time to reevaluate. But I think we bottomed in the market in June, stock market, and I think the yields topped in June. We'll see. All right, let's move on to, and by the way, there's hardly any economic reports coming out this week until Wednesday. So today and tomorrow is pretty light, hardly any earnings. So the market is just going to be trading off of technicals and news and things like that. Not a whole lot to really talk about. Wednesday, though, we're getting the June CPI. May, now this is the headline number, May rose 1%, and the expectation is that June is going to rise 1.1%. I don't think it's going to, but we'll see how it comes in. The core CPI is the one I'm really most interested in. May rose 0.6%. We're expecting 0.5%. So we'll see how that number comes in. But that's a big one on Wednesday. Thursday, we got initial jobless claims, and then the PPI also out on Thursday. And Friday, retail sales. So we got some big reports later in the week, but here today, tomorrow is going to be pretty light. All right, S&P 500. Well, I mean, if you're just looking at price action, I mean, lower lows, lower highs. If I look at nothing else and I just want to strictly look at technicals, I'm going to say, okay, we're just getting a bounce and that's it. And we're going to go back to new lows. It's easy enough, right? I mean, just like the last ones. Here we bounced, new low. Here was a really big bounce. And there was, I think, a lot of that right in here. This big move right here was option expiration week. But anyway, big move. And then what happened? New low. Reaction high to the upside, new low. So we're just reacting here to the upside, right? We're going to go back down to new low. That's what, if I just looked at this and I had nothing else to go off of, that would be my conclusion. If I didn't know what was going on under the surface, I didn't know what the rotation was, I'd be looking at this. And that's what a lot of technicians are looking for right now. They're looking at this bounce saying, oh, we're going to go right back down, because this is what we do in bear markets. We bounce, then we go down. Well, cyclical bear markets aren't quite the same as secular bear markets. Cyclical usually end within 3 to 6 months. There have been a couple of cases, not many, a couple of cases that drag on more than 6 months. But for the most part, 6 months is about it. So the signs I was seeing in June would also correspond with the timing of what most cyclical bear markets, when they would finally put that last bottom in. Now, the other thing that I think is somewhat interesting here is that if you look at these, I brought up 3 different ratios, and this is the rotation I'm talking about. Low, 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 low. This is the IWF, IWD. Low, 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 higher low. Wait a minute, what's going on here? So all of a sudden, growth is outperforming value at the large cap level. All right, let's so there's low, 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 low. Let's look at the QQQ versus the spider. Well, we got low, low, low. Wait a minute, we're going up. Money's rotating into the NASDAQ versus the S&P 500. That's kind of weird if you thought the market was going to keep going lower, and inflation and recession and all these things. I mean, those are horrible things for growth stocks. Why would the more growth-oriented NASDAQ start to turn higher against the S&P? Now, I mentioned earlier that there was a couple of signals I'm a little nervous about, and here's one of them. Now, low, 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 high, but when we've had this bounce here in the S&P, the XLY, XLP hasn't really, I mean, I would like to see it taking out this high. And this is probably, well, not probably, I would say this is the most important relative strength or, intermarket relationship that I follow. And, we're starting to see a little bit more strength out of Amazon and Tesla. And these are two of the biggest components of the XLY. But we're just starting to see, I mean, we held this prior low, so it's not bad. It's just not doing quite as well as some of these other, relative strength lines. And these are still moving up to new highs as well. So even though, we didn't put in a new high on the S&P from a couple of weeks ago, the IWF, IWD continues to rotate toward growth. We continue to rotate toward the NASDAQ. Not quite the same on the XLY, XLP. So this is one, if there's anything that's giving me a little bit of heartburn at night over a bottom call from June, this would be one. I don't want to see this move to a new low. That would make me a little bit more nervous about my call. So let's keep an eye on this one. But overall, again, if you're just looking at the chart, and there are some saying, well, we haven't had capitulation. Really? I mean, we maybe didn't see one candle that looked like that, or like this big reversing, or like this with the big long tail. We haven't seen any of that. But my gosh, we went from almost 4,200 down to 3,700 in 5 trading days. What more do you want in capitulation? I mean, 10% or more in 5 days? I don't know. I thought, maybe it's not the classic capitulation candle where we see that massive washout. But I mean, these lows, now it was quad witching day, which is when you're going to see the most volume of the year anyway, tendency. Look at June. Look at the third Friday in June right here. Here's the third Friday in March. See how that volume bar is up? Third Friday in December. See that volume bar? And third Friday in September. These are the quad witching days. It's just, you're always going to see more volume because there's a lot more options activity taking place. A lot of contracts expiring, others being put on. It's just when we always see more volume in the market. So those 4 days. So, you might look at this. I could say, well, that was capitulation, but I also know a little bit better because that's also the quad witching Friday. But still, the volume here was pretty good on this move to the downside. I mean, relative to all these other days in 2022, we were still up over 3 billion shares on 3 of the days that week. With that kind of a move to the downside, these gaps scaring everybody, the put call ratio shooting up. I don't know. I kind of think that it was a form of capitulation. Again, maybe not quite the kind that we like to see, but still pretty good. Anyway, what I'm looking for now, we've got some gaps that need to be cleared. Obviously, when you're coming down, you're putting in a lower low here. This high right here, in order to break the trend of lower lows and lower highs, you've got to get back up above that one. So ultimately, it's going to be up near 4,200 when we get final confirmation, in my view. And that would be a big level anyway. I mean, you can see the lows over here between 4,100, 4,200. here, 4,100, 4,200, we broke below it. We tested it, couldn't get through and back down. So there's no doubt in my mind, 4,100 to 4,200, that range on the S&P is where I think we're going to run into some more difficulties. That's why I think we could get through here. I think we got to be cautious. We got price resistance. We got the 50-day, but I wouldn't be surprised if we go through and maybe even go up and test this 4,200, put in a slightly higher high to have an upsloping neckline. And then when we come back down one more time, maybe over the summer, maybe to put in a right shoulder similar to this left shoulder, we could put in that bottoming reverse head and shoulder pattern. And then when we come out of that right shoulder, possibly later this summer, we could then explode, maybe even into early fall. I don't know how it's going to play out, but that would be one possibility where we're there. We go through the 4,200 and then we're into the fourth quarter and we just tear to the upside. I believe fourth quarter, we're going to rip higher. I don't know where we're going to be heading into that fourth quarter, but I think in the fourth quarter, we are going to be ripping to the upside. All right. Scooter reports. So in the EB Digest this morning that was just sent out a little bit ago, I talked about Moderna and I talked about scooter reports. And you can see Moderna last week. Let me show you how you get to this, by the way. This is a 1 week change on all the large cap stocks, all 1 week scooter change. So like Moderna is at 80.7. In a week, it went up 64. So it would have been up, it would have been at 16 the week prior. That's a huge move in the scooter. But how you get into here is if you click on this, your dashboard, and then over here on the left-hand side, go down under member tools until you get to summary pages. And under summary pages, you'll see scooter reports. Click on that. Now you can look at large cap, mid cap, small cap, ETFs, industries, whatever you want to look at, you can pull up in that menu. I just leave it on large caps. And now what it's showing me is the scooter starting at 99.9 and working its way down. But what I can do is sort this by change. These are the ones that went down the most on Friday. Here are the scooters that went up the most on Friday. And then if you change this to 1 week, it'll give you the 1 week change. So this is just a way of quickly identifying stocks that are making big moves on a relative strength basis. That's really what the scooters are, Stock Charts Technical Rank. It's a relative strength system developed by John Murphy, who I think is brilliant, way ahead of his time in terms of technical analysis, intermarket relationships. The intermarket relationship work is what really, really inspired me in John's work. That's when I started, the light started going off for me. And hopefully all the things I talk about, maybe the light's going off for some of you as well. You've got to follow relative strength. You have to follow relative strength. You cannot just look at a chart, not an absolute price chart. I mean, yes, that's very important. That's how you make money or lose money. But you really need to know whether money, you need to know if Moderna is a great performer in the pharmaceutical space. It might be going up, but it might be underperforming. You might find a lot of other pharmaceuticals that are doing better. Wouldn't you want to be in the ones that are doing better? Call me crazy, but that's what I would want. So yeah, so Moderna might be going up, but it might be because the group has been so strong. Let's pull up Moderna. And let me pull up on a relative basis. So here it is. You might say, well, yeah, it's just been going sideways for a while. That's not, not too bad. Well, look at the relative strength versus its pharmaceutical peers. It's starting to turn up the last week or so. And now we're seeing it on the scooter report. It's just starting to turn up relative to the pharmas. The pharmas relative to the S&P are starting to roll over. I don't know if any of you find that interesting. I think that's kind of interesting. But and look at all these hollow candles. You couldn't convince me that there isn't some accumulation taking place on Moderna right now. Look at the AD line going straight up for the last month. By the way, that came in right around the middle part of June when I called the bottom. We've seen a lot of these stocks that do better in growth environments. Many of these stocks have just been on fire for the past month. Money's rotating. Again, why is Wall Street all of a sudden rotating into this area? I don't know. Maybe it's temporary. We're going to find out. But Moderna needs to get through about that 190 level right there. That's where you're going to start getting absolute price confirmation. We're already seeing it under the surface. Money's already rotating. All right, it is 9:30, so the market's opening. Let's just quickly talk about, I want to just mention software. If you look back on this scooter report list over here, look at all the software names that are on the list. You got Paycom, CrowdStrike, Fortinet, MongoDB, Splunk, Datadog. All of these are in about the top 10 or 15 scooter movers in the last week, 6 software companies. So if you don't know what areas are doing well, this also, you can quickly identify, oh, software looks like it must be doing pretty well. We got a lot of relative strength movers. Well, let's look at software. Here's software getting back up to the 4,400 level. It's 10% off its low from mid-June, by the way. Notice that mid-June level again we're talking about. Notice software relative to the S&P set a low in May. Not in June, in May. In June, it went to a new price low. So again, if you're looking at the absolute price chart, we're breaking down. That's horrible, right? Why on a relative basis is Wall Street moving into software? Could it be that it's bottoming? They're the ones that pay all this money for these MBAs. Listen, Wall Street, those Wall Street firms, they may be a greedy bunch, but they're a brilliant bunch. They are really smart. They might be out trying to steal all of our money, but they're really smart. If you got to follow what they're doing. They're moving into software, just saying. All right, earnings spotlight. Later this week, I think it's on Thursday, we really get what I call the kickoff of earnings season. I always look for JP Morgan. To me, when JP Morgan reports, that's when earnings season is underway. It used to be Alcoa. Nobody cares about Alcoa anymore, but that used to always be like the trigger for earnings season. To me now, it's the banks. JP Morgan kicks it off. We're going to have Morgan Stanley on Thursday as well. Cintas. Friday, we've got United Health. By the way, I wrote an article a couple articles ago in the EB Digest talking about the fact that UNH, believe it or not, I mean, when I saw this, it was absolutely stunning. UNH, United Health, has beaten Wall Street estimates on the bottom line, earnings per share, 58 straight quarters. I was like, there's no way. There's no chance a company can beat. So I went on Yahoo Finance and went through their earnings calendar and went back. And sure enough, they have beaten estimates 58 straight quarters. So I said, well, maybe we want to watch UNH heading into its earnings report. And well, we just got back up close to its 52-week high on Thursday or Friday of last week. Today, it looks like it's down about 0.75% so far. But this is one that I was saying, hey, we might get a pretty good run heading into earnings. Well, they report on Friday, so we'll see what happens later this week. Wells Fargo reports Friday, Citigroup Friday, PNC on Friday. So we got a number of big banks coming up later this week to kick off earnings season. All right, first, let's just go to the dashboard. Let's see what's moving today. We'll do the 3 you must see. And we'll base it on, I'll do the 3 large cap movers here. So ICL, EXR, and MO. You can see right now, NASDAQ down 115 points. On a percentage basis, down more than the other major indices. But here you can see ICL, EXR, MO. These are the 3 big scooter movers for today. This is just for one day. So let's just take a look at the charts. I have no idea. I haven't looked at them. So ICL, I look at it and I say, okay, it's bouncing. The PPO at the lowest point right here was still pointing down. We're getting a bounce. I feel like we're going to fail at the 20-day there. I would not be a buyer. I'd be looking for it to come back down maybe to that 8.5 level, possibly even break down at that point. I mean, we'll just have to see. But I would not look at the volume dwindling as it goes up each day. I think it's being manipulated back to the upside. I'd be really careful here. So that was ICL. Let's do the second one. Well, the numbers they're changing, but here's Mo, and then Lennar. We'll do that one third. Altria Group. So this is in the tobacco area. Been getting beaten up down near support, bouncing. This is another one. I think maybe we get up to 44 or so. 20-day. That'd probably be the limit. I'm not saying it's going to get there. I'm just saying if it gets there, I would think you're going to see some selling take place. I'm not a fan. I don't like trying to catch these falling knives unless I see something on the chart that tells me, hey, money is really rotating in here. You can see the AD line, not particularly good. Nothing that I really like here. So I'd pass there. Last one, Lennar. Home builders are kind of interesting here because if rates are going to roll over, this group has been beaten up badly this year because of rates going so high. And when I say so high, on a relative basis, when I first started buying, when I bought my first house back in the 1980s, oh my gosh, I would have killed for an interest rate of 5 or 5.5 or 6% or whatever, wherever we are right now. I think my first house, I was 10%. So on a historical basis, we still have pretty low rates on mortgages. But after the last few years and with all the quantitative easing and everything that's taken rates down and kept them down for so long, my gosh, 5 or 6% sounds like, oh, how could you ever afford a house? Still really not that bad in the long-term scheme of things. But anyway, this group's been beaten down. It's obviously rallied with the yields topping and coming back down. But if this is a long-term top on the yields, then that is very likely to be a long-term bottom on the home construction group, home builders. So I'd be watching. You got some overhead resistance right in here. I'm going to say from about 78 up to about 83. It's where you got a lot of congestion on the way down. Just below 80 was holding for a while. And then the reaction highs have been up to about 81 to 83. So that's kind of the range. We're probably going to be bumping our head here on some overhead resistance for the next couple of weeks, I would guess. But that's it for me. Let's go back, take another look at the market, and we'll wrap this thing up. NASDAQ now down quite a bit, down almost 200 points. So very, very rapid decline. But hey, welcome to Monday. I'm not kidding at all. The long-term track record, I mean, it doesn't lie. These are facts. Mondays, 14% annualized return. That is negative 14% since 1950. That's the S&P 500 on Mondays. Not pretty. Anyway, that's it for me. I'll be back tomorrow over at Stock Charts TV. So tomorrow at 9 a.m., just simply go in here and click on Stock Charts TV, and you'll get the latest recorded episode of Trading Places Live. And of course, I'll be right back here at EarningsBeats.com on Wednesday. Make sure you do go over and sign up for our EB Digest if you want to come and attend tonight's free event. I'm going over how we put together our model ETF portfolio, which has been outperforming the S&P 500. I think it'll be a great event. So I hope we'll see you there. Anyhow, have a great day, everybody. Happy trading.